Hi guys, Joseph here again. This is a continuation of the Gartley pattern video, or part 2 if you like. And in this video, I'm going to take you from just seeing what a perfect description of a Gartley pattern is like to actually seeing it on a chart and also learning the way I trade it. So by now you should be familiar with all the rules that must be met before you can actually say that whatever pattern you're looking at is a valid Gartley pattern that you can trade. So if you don't know what those rules are, then I strongly recommend that you watch the part 1 of this video, because it's going to make a lot of things so much easier for you to understand, especially the things that I'm about to show you right now. Okay, so let's go over to the chart, and I'm going to use all the rules to actually try and identify a valid Gartley pattern. Okay, I'm not going to go into details because I've already done that in the previous video. So the first thing I'm going to do is go over to the US dollar Japanese yen chart. Okay. So what I'm going to do is I'm going to select a time frame that I usually use to trade. I usually use the 1 hour time frame or the 30-minute time frame, but for this reason I'm going to go over to the 1 hour time frame. Okay, so first of all, I'm going to give you guys a hint on the quickest way to spot a Gartley pattern. And this may not be a valid Gartley pattern because I have to use my Fibonacci tool before I can actually confirm it, but it kind of narrows it down for you, because these patterns can be so hard for someone who hasn't put the time and effort to actually train yourself in identifying this pattern. So this is the kind of structure I'm going to be looking at a glance. I'm going to be looking for something like this. Or in case of a bearish Gartley pattern, now this may not make sense to you, but trust me, it's going to be really important if you aim to be an advanced pattern trader, because it will save you lots of time, and timing is everything as we know it, especially in trading. So this is what I'm looking for. I'm looking for any structure that look like this. Okay, so going over my chart right now, looking at the overall picture of this chart, I can see a structure that look like this, and I'm going to go ahead and draw it out for you. So if you remember our first rule, the impulse leg, that's the first thing that you draw on a chart. So I can see a structure that look like this one, and because I'm drawing my impulse leg from top left to bottom right, I already know that I'm going to be looking at a bearish Gartley pattern. So my mindset straight away is tuned into me, looking for an opportunity to sell. And that is very important, guys. So I'm going to go ahead and label this chart just to make things easier. Remember, our starting point on a bearish Gartley pattern, we'll label it as X. There it is. And our end point of that impulse leg, we'll label it as A. So the next thing I'm going to do is bring in my second impulse leg, or the A to B leg. And if you remember our rules, we say that for this impulse leg, or the B point to be valid for a Gartley pattern, it must touch the 618 retracement and cannot touch any other retracement line after that. So I'm going to bring in my Fibonacci and go X to A, and what I'm looking for is the 618 retracement line. So we can see that the market has come into and touched the 618 retracement line. So B, we can say that this point is valid. Like, so far so good. Our X to A leg and A to B leg is valid for a bearish Gartley pattern. So now we move on to the next rule. I'm going to bring in another leg, which is my B to C leg. And if you remember, our rule for making sure that this C leg is valid for a Gartley pattern is that If we bring in a Fibonacci retracement tool, A to B, the rule says that for C to be valid for a Gartley pattern, it must touch the 382 retracement, and it can go on and touch any other retracement line after that, as long as it doesn't cross A. So let me just put a red dotted line. So that is the danger position. So for C to be valid, it must not touch A, but it must touch the 382 retracement. So we can see at this point that the C has come in, the C point has come in, touched the 382 retracement line, and even went beyond that to touch the 886 retracement. So it's still valid because C hasn't actually touched A. So we can go ahead, take that off. So now the next and the final rule is finding our entry point. Our entry point, the rule says that it must be a 127 extension of the A to B leg. So I'm going to bring in my Fibonacci again. Go there. Or actually what I'm going to do, I'm going to bring in this extension Fibonacci. It's still the same, but swing low to swing high, back down again. I haven't got the 127 on that one, so I'm going to use, sorry for that, I'm going to use that one. So A to B, and for us, the entry point must be at the 127 extension point. So by the way, this has already happened, but I'm just showing you guys, an easy way to just spot a Gartley pattern, because usually you have to spot this before the market has actually done, what it's done after that. You have to be able to spot. That's why I say being able to spot this pattern or this structure when the market is moving before it actually completes the Gartley pattern. It's really gonna help you, because if you can spot this when the market is, it's in its trend, if you can spot this, then it's very easy to just predict. All you have to do is just predict where the D point is going to be, which is the 127 extension, and all you have to do is just wait for it. So looking at this chart now, we can see that the market, we've got a complete and a perfect Gartley pattern. So let me go ahead and label that as D. And guys, to make things pretty, I'm going to complete the triangle. It's not really important, but and I'm going to change that to red because it's a bearish Gartley pattern. So because it's a bearish Gartley pattern, we would be expecting this market to come into D and then reverse and go back down. So if you're trading this, before this part, this is what you're gonna, basically this is what you're gonna be left with when you're trading this. So let me just put that area in a different color. So as a trader, you need to be able to see this pattern before what actually happened in this area, this different colored area happened. So you got to be able to spot this pattern. Right now I'm spotting it because the market has already moved. The Gartley pattern has been completed. The trade is done and dusted. But you need to be able to use your skill and be able to predict and see this pattern before this move after, in this shaded area happened. So once you're able to do that, and because it's a bearish Gartley pattern, the next thing to do is you're either going to place a sell order right there, or you're going to wait for the market to come into the D point before actually selling. Because like I said, you're expecting the market to go back down after completing a bearish Gartley. This is the way I do it. Before I usually place a trade, once I spot this pattern on a chart, I usually wait for the market to come into the D point. The reason I do this is because I usually wait for a confirmation. I use my RSI to see if I get an oversold conditions. That's when I enter the trade, because I get better results that way. A lot of people do it differently. If you don't have so much experience, or if you haven't done any box testing, people, you can just go ahead and place a limit order right there to sell. But at the end of the day, it all depends on your system, your methods, and whatever you've back tested. But yeah, so you place it, you sell right there, and once you've done that, the next thing to do is obviously aim, where your targets and your stops are gonna go. Now, when it comes to targets, a lot of traders do it. Yeah, there's a general way of doing it. So what we usually do is we get our Fibonacci retracement from A to D. So we combine this A to B leg and the C to D leg and just get a Fibonacci retracement of the whole thing. And to take our targets, there's two. You have to take your targets at two different places. The first place to take your target is at the 382 retracement. So I'm going to draw a little box all the way to the 382 retracement. I'm going to change that to green. And the second box, which is a second target, is going to go all the way to the 618 retracement. So that's the way to take your targets when you're trading this pattern. Now, when it comes to stop loss, it's different with a lot of traders, but there's a general way of doing it. The general rule says that your stop loss, if you're trading a bearish Gartley pattern, your stop loss has to go somewhere above X. So anywhere above F, you can place your stop loss right there. But I do have a different way of doing it, and this is the way I do it. So because I know this pattern is only works 60% of the just about 60% of the time. So what I usually do, I make sure that my risk to reward ratio on trading this pattern is at least 1-to-1 on my first target. So what I do is I clone this and then put it right there. Change that to red, and then my stop loss goes right at the end of that box, because that gives me a 1-to-1 risk to reward ratio on my first target. So basically, if I win 60% of my trades, then I end up making a good returns. And that's not even putting my second target into consideration. So that's it, guys. Once you've already done that, all that's left to do is just managing your positions. And the way to do that is, as soon as you get involved in this trade, if your first target gets hit, all you have to do is just move your stop loss to break even, and just let whatever happens to your second target, because that way you've already saved some profit. And you never want a winning trade to end up becoming a losing trade, because trust me, every pip counts. After all, making pips and making sure you keep it, it's obviously the most difficult thing to do in trading. So I'm gonna go over to my trading view page and show you guys a few trades that I've placed using the Gartley pattern and how it ended up working out. So I'm gonna go over to there we are. I've got this one is a bullish Gartley pattern trade that I've placed on a Canadian dollar against the Japanese yen. So as you can see, this is what this is what you should be able to do. I spotted this Gartley pattern before it actually completed. So this is how you trade this pattern. So you have to spot this pattern and predict that it's going to come into this place and complete, and then because it's a bullish Gartley pattern, you would expect it to reverse, hitting your first target and hopefully your second target. So I'm going to play this for you and you will see exactly what happened, because on this website it actually shows you when you place your trade and what actually happened after you've made your prediction. So I'm going to go ahead and play it. So as you can see, guys, after I placed the trade, the market came down into the 127 extension, or the D point of our Gartley pattern, and then it reversed back up, hitting our first target and then our second target. So this is it, guys. And there's lots of examples like this on my trading view page. You can go and you can see the results, every single, mostly, there's lots of different patterns. And so I hope this video has helped some of you on how to understand how to trade patterns in the forex market. So in my next few videos, I'm going to actually be talking about a different pattern, the cipher pattern and the bat pattern, like I said in my previous video. So thank you very much for watching. I mean, if you need any more information, there's links to my website where you can sign up and get my weekly video, or you can go on my trading view and hopefully you can educate yourself there. So and if you like this video, leave a comment, share it, anything that helps. So thank you so much, guys, and Until next time, keep it simple. Talk to you soon.